One of the most important things is to be patient. We need to be patient before we get into our trades. We need to wait for the market to come to us. So many people try to force trades. They like don't get enough action, so they put on a trade when they really just need to wait. And then once they're in the trade, they want to take quick profits when what they really should do is wait, relax, make some money. The longer you're in a position, the more money you're going to make. Hey everybody, Courtney Smith here with this week's edition of Wall Street Winners. So glad to have you here. Let's figure out how we can make some money this week, shall we? And of course, if you read this and memorize it, well, you really won't make any money at all. But okay, now let's take a look. Market moves. Not the NASDAQ, but S&P and Dow didn't make new all-time highs, but the NASDAQ did. But look at what we've got here. We've got a divergence between the purple predictor and the price action. Now, I'm going to draw a conclusion in just a second, but I want to point out here that the smart money is starting to take profits here on our S&P. Now let's take a look at the Dow, get another perspective. And you can see that the DI plus, which is the green line, popped up above the red line. So we're starting to see a lot of buying pressure, and at the same time what we're seeing is selling pressure from the smart money. Okay, so what we're doing is seeing a rotation of money. The smart money is moving elsewhere. I'll show you where in a second. And the dumb money, the retail money, the mutual fund money, your pension plan money, they're coming in and they are buying, substituting for the smart money. So smart money out, dumb money in. That's okay with us. I'd rather follow the smart money. Makes me nervous. But as long as there's enough dumb money coming in, that's okay. That can be a bull market. Now, this is where the money's going. It's going into the NASDAQ. The purple predictor is not negative here. There's no divergence. Now, it's not super bullish, let's be clear, but nonetheless, it remains on a buy signal. So look for money to go out of Dow-type stocks, out of S&P stocks, and to continue to move into NASDAQ-type stocks. That's where we need to put our money. Biotech, medical tech, high tech, anything with tech in the name is okay with me. And the NASDAQ went to new all-time highs. That's incredible. Now seasonality, our seasonality indicator continues on a roll. It's relentless, continuing to keep us focused on being on the long side of the market. And the interesting thing is we're supposed to, sell in May and go away. Here we are in June and we're making new all-time highs in the Russell 2000, which is what the IWM is. So what does that mean? That means we need to stay long small cap stocks, small cap technology stocks. And what's our portfolio filled with? Oh yeah, small cap, mid cap, technology stocks. So we've got our portfolio positioned beautifully. Now, normally you can see June. Now in June, notice that the negative seasonality starts to end. If we look at the blue line, which is all midterm election years, really the bearish part of the summer seasonality ends in about a week. And then it just goes sideways for 3 months. The midterm after a positive post-election, which is what happened last year, that shows negativity into October, but we're not seeing any negativity. And so when we don't see negativity, when we're supposed to see negativity, that's very bullish. Because it means that the market, the underlying situation in the market is so powerful that it can overcome the negative seasonality. And so when the negative seasonality ends in September or October, this market's going to pop. It's just going to pop. Okay, yield curve, now we're down into neutrality. I pointed out to the very far right-hand corner. We got to keep an eye on that. If it gets down to around 0.25, I'm going to start to get very nervous. When it gets down to 0.25, I'm going to call for a major bear market. So we need to keep an eye on this. We're at 1.0. We haven't been at 0.25 since 2006, 2007, and that's what, of course, caused the big bear market. But you already know that because you're a super cool kid who subscribes to Wall Street Winners. Okay, asset allocation moved in favor of the stock market and away from bonds, so that's supportive. The stock market risk indicator continues to boom, showing that the market has no appetite for dull, boring, safe havens. They want to rock and roll. How do we know that? They're buying the IWM. They're buying the NASDAQ. They're not buying big, boring companies in the Dow and the S&P. So the picture is all fitting together. Now, global shares are clearly not where it's at. Now, these global shares are heavily influenced by two sectors. European country stocks being hammered by the Italian crisis, but also emerging market stocks are being crushed by the tightening Fed policy, and as money floods out of the world into the U.S., causing the U.S. dollar to go up and emerging markets to go down. Bonds, they came under pressure last week until Thursday. Thursday we got a pop up, but Friday we kind of reversed it all. Really don't want to do anything here in the bonds at this point. Our indicators remain suggesting we should see lower interest rates. All three of our indicators, gold, 10-year treasuries, and now even the CRB index are all pointing for lower interest rates. In other words, higher bond prices. Now, the dollar came under some pressure, really technical pressure, profit-taking pressure, and worries about trade wars. But nonetheless, and I don't really have a position here anymore. Once we broke that uptrend line, I think that the best thing to do is to stand aside, and we'll just wait for further price action. Gold has just been steady. Now, I showed you that red line. I've shown it to you now for weeks, and the market's just hovering just under that line. We need to get a break above 1312 before the bull market is up. But right now, we have to consider this to be in a very, very weak bear market. But you know what? I don't like being involved in any market unless I can say the word strong in front of it. Strong bull, strong bear. If I can't say that word, you know what? Let's go play in another sandbox. All right, now our gold indicators, kind of neutral, not really going anywhere, so boring. All right, WTI, I'm still bearish. We still have a big increase in supply coming this year, but I think it's not going to be as bearish as I thought before, because both Russia and Saudi Arabia are kind of backtracking a little bit on what they were saying. Nonetheless, I actually think that right now demand for oil is going to decline, is going to be less than what the market looks like, and supply is going to be higher. So I'm still looking for this to break below 60 in the near term. Bitcoin, I'm falling asleep. So far, it's done exactly what we told you it would do, but unless it breaks the dark blue lines at 64.51 or 99.60, I'm going to look for it to bounce a little bit, maybe up to 9,000, but generally speaking, this is boring. Who cares? All right, freebies, love having you there. Now that's all gone. Love having you here, freebies, and you know what to do. Fully paid up members, hang in there just 1 second.